We are so glad you're here with us today because we are looking at something that honestly feels like a magic trick.
Oh, it really
Like,
does.
have you ever seen one of those optical illusions where it looks like a beautifully carved ornate vase?
Right, but then you shift your focus just a fraction of an inch.
Exactly. And suddenly you realize you're actually looking at two faces staring right at each other.
Yeah.
Your brain literally has to choose which reality it is seeing at any given moment.
Yeah, it's a classic trick of perception, You physically cannot process both the vase and the faces at the exact same time. Your mind just forces a choice based on the context you focus on.
And usually, when you're looking at a company's financial statements, you don't expect it to act like a psychological illusion. You just expect the numbers to be the numbers.
Right, it's pretty binary. You either made a profit or you didn't.
Yeah. Your revenue is up or it's down. But today, we are looking at the ultimate financial optical illusion. Welcome to another deep dive. Today, we are tearing into a comprehensive equity research assessment on a highly volatile, completely fascinating defense technology company called Ondas. The ticker is ONDS.
And it is, the absolute definition of a Jekyll and Hyde stock. Depending on which page of the financial report you look at, you are either seeing the next titan of the defense industry or...
Our company teetering on the edge of a cliff.
Exactly. It's wild.
So our mission today is to unpack this split personality before a critical upcoming catalyst. Because on one hand, you are looking at a company boasting a mind-bending 793% year-over-year revenue growth.
Yeah.
I mean, that is the kind of number that makes investors start salivating.
Yeah.
But on the other hand, it carries massive structural risks that most casual investors might just completely miss if they only skim the headlines. Okay, let's unpack this, because this situation is a masterclass in why you can't just read headline numbers.
It really is. To understand the illusion, we first have to look at what is driving that initial incredibly attractive view, right? The bull case. Because the growth numbers here are not just good, they are staggering.
Hypersonic, even. I mean, we are talking about a record first quarter for 2026 with revenue hitting $50.1 million.
Right.
That is a tenfold increase year over year, 10 times the revenue in a single year. And it doesn't stop there.
No, they actually raised their full year 2026 revenue guidance not once, but twice.
Which is huge.
Yeah, it is now sitting at a minimum of $525 million. Plus, their backlog, which is the pipeline of orders they have sitting there waiting to be fulfilled.
Right, the guaranteed future work.
Exactly. That has surged to $457 million. So if you are just looking at a stock screener, you see a rocket ship.
You really do.
What's fascinating here is how they are structuring their offerings to achieve this kind of scale. Because Ondas operates what the military calls a system of systems platform.
A system of systems. Okay, so they aren't just selling like one isolated widget.
Exactly. They have created a networked ecosystem of defense technology. So they have tactical drones through subsidiaries like American Drone and Mistral.
Okay.
They have counter-drone technology through a company called Centrix. And they even have autonomous aerial delivery through DZYNE and Sentinel.
So help me visualize what a system of systems actually looks like in practice. Because to a layperson, it just sounds like they own a bunch of different drone companies. How do these actually interact in the field?
Right, good question. Think about a forward operating base. A single drone is useful for, looking over a hill. But a system of systems means the base is protected by Centrix.
Which is doing what exactly?
It's constantly scanning the airspace for enemy drones and neutralizing them. And meanwhile, DZYNE autonomous vehicles are running supply routes to bring ammunition to the base without risking human drivers.
Oh, wow.
And simultaneously, you have Mistral drones out gathering intelligence. So Ondas is trying to sell the entire interconnected architecture to the military rather than just one piece of the puzzle.
That makes a lot of sense. So you aren't just buying the hardware. You're buying the entire life cycle of the drone airspace. And this strategy has seemingly built them a massive defense moat.
Oh, massive.
I mean, the anchors here are these huge contracts. We're looking at a $982 million contract ceiling for Mistral, a recent Army order exceeding $50 million.
Right.
An Air Force Research Laboratory award over $6 million. They're even branching out commercially, providing counter-drone protection for the Jacksonville Jaguars NFL games.
Yeah, the commercial application is really interesting.
But I do have a question about that $982 million figure. Because a ceiling isn't exactly a check they've already cashed, is it?
No, it is definitely not cash in the bank today. That is an indefinite delivery, indefinite quantity contract, or an IDIQ.
Okay.
It essentially means the military has pre-qualified the company and set aside up to nearly $1 billion that they can spend with them over a set period.
Got it. So it's like a pre-approval.
Exactly. It is a massive vote of confidence. It tells the broader market, the military has vetted and trusts this technology. And that kind of institutional backing is incredibly hard to replicate, which is why it forms a moat.
But, and this is a huge but, there's a massive caveat here regarding how this moat was actually built. Because they aren't necessarily organically entrenching themselves through in-house research and development over decades, right? Like a Lockheed Martin or a Raytheon.
No, not at all.
This moat is being constructed almost entirely through acquisitions. They're just buying these subsidiaries like DZYNE, Omnisys, American Drone.
Yeah, they're aggregating talent and technology rather than incubating it from the ground up.
It honestly reminds me of a sports franchise that is just desperate for a championship.
Mm-hmm.
Imagine a team that hasn't drafted or developed a single good rookie in years.
Okay, I see where you're going with this.
Instead, the owner just opens the checkbook and buys all the most expensive free agents on the market to assemble a super team overnight. It looks incredibly intimidating on paper, but you really have to wonder about the foundation.
That is a brilliant way to frame it. A team of expensive free agents might have the best stats in the league, but they also have the highest payroll.
Right.
And if they don't gel immediately, the cost of keeping them together can just bankrupt the franchise.
Which brings us to the core tension of this deep dive. Is a moat built entirely on acquisitions actually a sturdy moat, or is it just a temporary wall of cash?
Right.
Because if they're winning all these massive defense contracts, why is the overall assessment rating in our research a cautious neutral?
Well, because we have to look at how they were paying for all those expensive free agents. And when we look under the hood, the reality of the cash burn is just severe. Integrating all of these distinct companies is an incredibly expensive logistical nightmare.
Let's pull back the curtain on that cash burn for a second. The operating expenses exploded year over year. They went from $9 million to $36.9 million.
Yeah, a huge jump.
And their adjusted EBITDA loss, which for those listening is a standard way to measure a company's day-to-day operating profitability before taxes and accounting quirks.
Right, the real operational health.
Exactly. That loss actually widened in the first quarter to $10.9 million. So they're basically bleeding cash to keep the lights on and stitch these companies together.
And this is exactly where that financial optical illusion we talked about earlier comes into play in a way that is highly dangerous for the average investor.
Ah, yes. The net income illusion.
Yeah.
If you look up this stock right now on your phone, you will see they reported a first quarter net income of $361.2 million.
Mm-hmm.
That results in a trailing 12-month net margin of 253%.
We really need to pause and think about the absurdity of a 253% net margin.
It's crazy.
That metric implies that for every single dollar of revenue Ondas takes in, the accounting says they're somehow keeping $2.50 in profit.
Wait, what?
I mean, in the physical world of manufacturing defense hardware, bending metal, writing software, that is mathematically impossible.
I mean, if I'm an average retail investor scanning a basic stock screener, I see a 253% net margin, and I think I've found an absolute gold mine. I'm thinking this company has invented a literal money printing machine. How is a metric this distorted even allowed to be published without a massive warning label?
Well, it is allowed because it follows standard accounting rules, but it completely obscures the underlying operational reality.
Okay, so what's the trick?
That $361 million net income was entirely driven by a non-cash warrant gain of $389.5 million.
A non-cash warrant gain. Okay, I know we have listeners who are financial experts and others who are just starting out. Can you break down what that actually means and why no actual money changed hands?
Absolutely. So warrants are essentially options given to investors or lenders to buy stock at a certain predetermined price in the future.
Okay.
And they are treated as a liability on the company's balance sheet. Because the stock price fluctuates in the open market, the accounting value of those warrants also fluctuates.
Right, so if the stock price goes up or down, the value of that liability changes.
Precisely. And here is the deeply ironic twist. When a company's stock price drops significantly, the value of those warrants, the right to buy the stock, becomes much less valuable to the investors holding them.
Makes sense.
Because the liability drops, accounting rules allow the company to record that drop as a gain on their income statement.
Wait. So you're telling me that because the stock performed poorly, the liability shrank, and they got to record a $389 million profit on paper.
That is exactly what happened. The irony is staggering.
Wow.
The stock doing poorly on the market created a massive paper profit on the balance sheet. But no drones were sold to generate that $389 million. No new contracts were signed for it. It is literally a phantom number.
That is wild.
Yeah.
So when you strip away that accounting quirk, when you wipe that phantom number off the board and look at the true operating economics, the actual cash spent to build products, pay salaries, and keep the lights on, what does the picture look like?
The underlying operational loss for the quarter was $42.7 million.
Okay, so they didn't make $361 million. They fundamentally lost $42 million operating the business.
Correct. And this ties directly back to your free agent analogy from earlier. They recently closed the massive acquisition of DZYNE to build out that autonomous delivery capability.
Right.
And the cost of that acquisition was $875.8 million.
Wait, earlier we established they are burning cash.
Yeah.
If they're losing $42 million a quarter operationally, how on earth did they pay nearly $900 million for DZYNE?
Well, they paid $200 million in cold, hard cash, which they had to go out and raise, and they paid the rest by issuing approximately 85 million newly created shares of stock.
And there it is. Issuing 85 million new shares leads to the structural terror our sources flagged, a 324% cumulative share dilution.
Yeah, it's massive.
They're paying for these acquisitions by aggressively printing more shares. So for you, the listener, if you're holding this stock, that means every single share you own represents a smaller and smaller slice of the overall company pie.
It is a massive structural risk. However, to be perfectly fair to the data and, present both faces of the vase here, there is a legitimate silver lining in the fundamentals.
Okay, what is it?
Ondas actually achieved adjusted EBITDA profitability at the product company level in the first quarter, which was 6 months ahead of their prior target.
Okay, let's make sure I'm following this.
Okay.
The parent company, Ondas, is burning cash and printing shares. But the individual subsidiaries, like the actual companies they bought, like Mistral and DZYNE, are starting to become profitable on their own.
Yes, exactly. The consolidated loss, that $10.9 million EBITDA loss we discussed,
Right.
that comes entirely from the parent company's massive corporate overhead, legal fees, and the friction of integrating all these acquisitions.
Okay, that makes sense.
But the underlying individual businesses they purchased are actually showing healthy unit economics. They are selling hardware for more than it costs to make. That proves the core technology has real, sustainable commercial viability, even if the parent company's balance sheet is currently a bit of a mess.
So we have this stark contrast. You have incredible top-line revenue growth, massive defense contracts, and profitable underlying subsidiaries on one side. But on the other side, you have a massive corporate cash burn and terrifying share dilution. How is the broader market reacting to a situation this complex?
With complete and utter schizophrenia.
Let's look at the divide because it's pretty extreme. On one side, we have the optimists, right? The Wall Street analysts. 8 different analysts maintain a unanimous strong buy rating on this stock.
Yeah.
Their average price target is 19.81. Given the stock is currently trading around 9.11, they are projecting a massive 117% upside. But with 324% dilution, how are analysts possibly justifying that kind of optimism?
Because analysts are generally building their models based on the future potential of that $457 million backlog and the near billion-dollar contract ceiling.
So they're looking way out.
Exactly. They're looking 3 to 5 years out, assuming the integration costs will eventually vanish and the revenue will flow cleanly to the bottom line. They are basically modeling perfection.
But then you have the pessimists in this scenario.
The insiders. Over the trailing 90 days, executives and insiders of the company have recorded a net sale of 1.86 million shares.
Right, and the sources mention a specific metric for this, the insider MSPR, sitting at negative 15.81. Without getting bogged down in the acronym, that essentially means a metric measuring insider sentiment is deeply negative. The pace and volume of insiders cashing out far outweighs those buying in, right?
Exactly. It tells a very specific story about internal confidence. When the people running the company are selling shares while the analysts are telling the public to buy, it creates a deeply unsettled market.
I can imagine.
And the chart reflects this chaos. The stock is incredibly volatile. It is down 40% from its 52-week high, but simultaneously up 195% from its 52-week low.
It's just violently swinging back and forth.
If we connect this to the bigger picture, we have to look at a metric called beta. Ondas has a beta of 2.99.
Let's explain how beta works in practice for someone managing their own portfolio.
Sure, so the broader market, like the S&P 500, always has a baseline beta of 1. If a stock has a beta of 1, it moves roughly in sync with the market.
Okay.
A beta of nearly 3 means this stock is 3 times as volatile as the overall market. So if the broader market goes up 2% on a good news day, Ondas might jump 6%.
Oh, okay.
But if the market drops 2%, Ondas is likely to plunge 6%. It amplifies both the upside and the downside moves violently.
So it's an amplifier. And when you combine a 3x amplifier with heavy insider selling, the picture gets very murky. Let me try an analogy here.
Go for it.
This dynamic feels exactly like a highly rated, trendy new restaurant in the city.
Yeah.
The famous food critics, the analysts, are giving this place 5 stars. They are writing glowing reviews about the menu, telling everyone to get in now before you can't get a table, projecting a long, successful future.
But meanwhile, the head chef and the owners, the insiders, they are quietly sneaking out the back door every night to eat somewhere else. Exactly. Who do you, as the listener, trust more here? The analysts' spreadsheets projecting future glory based on a menu, or the insiders' actual wallets cashing out today?
It is the ultimate question of this deep dive. Analysts are looking at the $982 million contract ceiling. Insiders are looking at the immediate, pressing need to integrate massive companies, manage a dwindling cash flow, and survive the next few quarters of extreme operating expenses.
Right.
The insiders are taking their chips off the table while the price is relatively stable.
Because the stock is just hovering in this uncertain, highly volatile middle ground. It's trapped between the critics writing 5-star reviews and the chefs sneaking out the back.
Yeah, that's a great way to put it.
And a stock in that position, especially one with a beta of 3, always needs a catalyst to violently push it in one direction or the other. It can't stay suspended in midair forever.
And for Ondas, that catalyst is right around the corner. The August 13th crucible. The impending second quarter earnings report. And the stakes could not be higher because of how the market is valuing them right now. They have a trailing price-to-sales ratio of 53.74x. Help me understand why a multiple of almost 54x is so dangerous here, specifically for a defense hardware company.
Well, a price to sales of almost 54 means investors are paying $54 for every $1 of revenue the company generated over the past year.
That sounds extremely high.
It is. In the software world, like SaaS companies, you might see high multiples like that because once the software is written, selling another copy costs almost nothing. The profit margins are enormous.
Ondas isn't selling software subscriptions.
Exactly. They are selling physical drones. They are bending metal, sourcing lithium batteries, and managing complex physical supply chains.
So the margins are completely different.
Completely different. Hardware margins are inherently much lower than software. So paying a 54x multiple for a hardware company means the market is pricing in absolute flawless execution for years to come. They aren't just pricing in growth, they're pricing in perfection. There is zero room for a delayed contract, a supply chain hiccup, or a missed revenue target.
And that brings us to the second half execution math, which is where it gets really sweaty for anyone holding this stock. To hit their self-stated minimum target of $525 million in revenue for the year, Ondas needs $407 million in revenue just in the second half of 2026 alone.
And what is the market consensus expecting them to hit?
$408.5 million. That leaves a cushion of just $1.62 million on a $500 million target. Think about that. To me, that is like driving a speeding semi-truck through a long tunnel with half an inch of clearance on either side of your mirrors. What happens on August 13 if they scrape the walls?
If they scrape the walls, that 2.99 beta guarantees a violent derating. The market will mercilessly correct that 54x valuation. We are looking at 2 very specific, very extreme scenarios based on the research.
Let's hear the upward path first. How do they successfully thread the needle through this tunnel?
The upward path requires Q2 revenue to hit the consensus of roughly $68 million. But more importantly, management previously cautioned that Q2 adjusted EBITDA losses would be their absolute worst, the peak of their cash burn, before improving in the second half.
Okay.
So on August 13th, they must definitively prove that the losses have indeed peaked and are trending down. Furthermore, they need to show they're actually delivering on their backlog.
Right, because an order isn't revenue until it's delivered.
Exactly. For instance, they have systems from a $190 million Mistral order scheduled for delivery in Q3. Awards are great for headlines, but award values don't automatically equal recognized revenue until the product is in the hands of the military. They have to prove they can deliver physical hardware on time.
So what does this all mean for the downward path? Let's talk about the existential dread here.
If revenue misses that $68 million mark, or if the EBITDA losses widen even further beyond the $10.9 million we saw in Q1, the illusion shatters.
Man, that's brutal.
The market will realize they simply do not have the operational runway to hit that $407 million second half requirement. And if they have to cut that $525 million full-year guidance, the stock will plummet.
So if the stock plummets, doesn't they break their entire business model of buying companies with shares?
This raises an important question, and you've hit on the exact danger. This is what analysts call a death spiral.
A death spiral, yeah.
If a company relies on its high stock price as currency to buy other companies, and the stock price crashes, they suddenly can't afford to make acquisitions anymore. The music stops.
Right.
Plus, sitting quietly in the background is another massive risk. 45 million shares from the DZYNE lockup expire in January 2027.
Lockup expiration. So millions of shares that were given to the DZYNE founders and investors during the acquisition, which are currently frozen and can't be sold, will suddenly unfreeze and flood the open market in January, putting even more downward pressure on the price.
Exactly. If the stock is already falling, those insiders might rush to the exits to salvage whatever value they can, accelerating the drop. The margin for error isn't just thin, it is practically microscopic.
It's an incredible story of contrasts. To tie this all together for you listening, we are looking at a company that is undeniably successful at aggregating massive defense contracts.
Unquestionably.
Their system of systems approach is highly attractive to the military. They have an incredible suite of tactical drone and counter-drone technologies. The top-line growth is very real, and the institutional military demand is very real. But this entire castle is built on a fault line of severe structural dilution, heavy insider selling, and a valuation that demands utter perfection with absolutely zero margin for error.
And it serves as the ultimate reminder for anyone navigating the markets. You can never rely purely on top-line revenue growth or a headline net income figure.
So true.
You have to look past the paper gains, understand the mechanics of warrants, and uncover the true operational cash burn beneath it all. You have to force your brain to see both faces of the Reuben vase simultaneously.
You really do. You have to look at how the sausage is made, or in this case, how the drones are funded. As we wrap up this deep dive, I want to leave you with a final thought to mull over, specifically regarding their whole strategy of buying their way to the top.
Let's hear it.
If a company's competitive moat is essentially purchased through continuous stock dilution, rather than built through unique, irreplaceable in-house innovation, at what point does the cost of constantly expanding that moat become the very thing that sinks the castle?
That is the multi-million-dollar question.
We'll see what the market decides on August 13th. Keep your eyes open, do your own research, and we'll see you on the next deep dive.